This week, the Friday jobs report showed employment in the US during the month of July increased by 528,000. This increase in jobs, nearly double the amount expected, represents a decrease in the unemployment rate to 3.5%. Both the level of employment and the unemployment rate are now back to pre pandemic levels. Today, we're going to dig into jobs data and discuss how this better than expected report may impact monetary policy decisions at the Federal Reserve. First, as I mentioned, the labor market has been improving, which is good news. However, simply getting back to the pre pandemic level is not, in our view, a sign that the jobs market has fully recovered. As we can see here, the workforce is still below the longer term trend level of employment growth. The jobs market is digging out of the hole and still has more to go to reach trend level. Secondly, the unemployment rate, or the percent of the labor force that is unemployed, stands at 3.5%. Again, this is good news. The unemployment rate by itself, however, doesn't provide high-def clarity on how many people are in the labor force. For this, we look to the labor force participation rate, which represents those employed or seeking employment, divided by the working age population. Here we see that the labor force participation rate has been, for the most part, declining. We have seen declines in recent periods, and also importantly, if we zoom out, we have seen a longer-term decline in the labor force participation rate since the early 2000s. This longer-term trend has been in part driven by demographics. Think aging baby boomers retiring and exiting the workforce. Now, this means that the US labor force has been shrinking, which can present some challenges as both the unemployment rate and the labor force participation rate are key measures of economic health. Now let's address how this recent jobs report may impact Federal Reserve actions on the go forward. The Federal Reserve, or the Fed, has a dual mandate of controlling inflation and seeking maximum employment. We know that the Fed has been increasing short-term interest rates this year to help reduce the rising level of inflation. With this strong employment report, the Fed, in our view, will continue on the path of aggressively increasing short-term interest rates. Moreover, since the jobs market is improving, the Fed has room to lean into its inflation mandate. Stay tuned for the July inflation report on CPI that will be released next week. Markets will be watching to see if the trend continues, or if maybe, just maybe, we've hit peak inflation and are starting to round the turn, potentially leading to a more accommodative monetary policy.